up, everyone, and welcome to the first podcast of 2019. My name is Julian, and with me is Ali in a slightly new arrangement. Mm-hmm. Now we're face-to-face while we do the podcast, so it'll be a bit more intimate, let's say. And for this first intimate topic, what are we going to be discussing?
We're going to be talking about RSP loans.
You started with a sexy voice there.
I know. Well, you didn't let me start with my famous weird pitch to start the episode. But RSP loans, and why RSP loans? It's because now we're heading into the end of the tax season. We're going to be filing taxes soon in April, and the RSP deadline will be at the end of February.
Is it the same in the States and Canada, the deadlines?
I think the States right now are already, they can file as of now, and they're already getting their tax refunds.
Okay.
That's the government shutdown. A lot of people are waiting on tax refunds, and they don't know if they're going to get them or not.
Okay.
That's a whole other topic that we could talk about, how it kind of impacts everything. But RSP loans, you have until the end of February to contribute to your RSP and use it for the 2017 tax year. 2018 tax year, sorry, wow.
Yeah.
2018 tax year. And obviously the RSP is really good because it can be used, any amount you put into it will be used as a deductible against your income.
So how does that work exactly?
So every dollar so you're allowed to put in 18% of your income up to a max of, I think, $20,000 a year. So any 18% of your income can go towards your RSP, and any dollar you put in will reduce your gross income.
I'll tell you what the maximum contribution is, because it's either or, so either like 18% or
a max of X dollars. But the difference between, so the reason why RSP is good in terms of a tax perspective is because it's a deductible as opposed to a tax credit. So a deductible reduces your gross income, and a tax credit reduces your taxes paid. So if you don't have any taxes paid, your non-refundable tax credits are kind of useless.
Yeah.
The RSP gets applied in any scenario and can be carried forward as well.
Yeah, so what it does is if you say first off, the max in 2016 was $26,930.
Okay.
So in 2017, it's probably going to be a little bit more, probably around like $27,500 or $2,800. So if you put $5,000 in your RSP and you made $50,000 for the year, essentially you made $45,000, right, from a tax perspective?
Yeah, kind of.
Pretty much.
Kind of, yeah. So on your income, you're going to be reporting 50 minus 5.
Yeah.
And 45. So your tax savings are going to be that $5,000 at your tax rate.
What if your $5,000 are split between two brackets? So let's say 47.5 is at the margin, the rates for that bracket is 3%, and then the next one is 36.
So 2,500 will be at 36. 2,500 will be at 30. Okay. So that's why if you can play around with. Sometimes you can't because you're kind of in the middle of a bracket, but if you fall towards the lower end or the higher end of a bracket, you can put X amount of dollars and it'll bring you below that bracket. So
but being below the bracket doesn't matter so much. It's just
yes, but now that portion of your income that was taxed at the higher bracket is not going to be anymore.
Exactly.
You reduced it down.
Yeah.
So you can play around with those. And usually the thing is, so why now the RSP loan?
Yeah.
Why would we?
Because we actually will make a podcast on RSPs, and we'll compare them obviously to tax-free saving accounts. We'll probably release that one first. But yeah, in this case, so why the RSP loan?
So I just asked you that question, but anyway, the RSP loan. Why is it good? It's because.
Well, I think we should explain what it is first.
Okay.
Right. So simply put, an institution lends you money to put in your RSP. And you would have to pay that money back over a fairly short period of time, usually like a year. And that's it. Usually you would have to invest that money at the institution that gives you the loan, especially if you're getting like a lower rate or something, like a promotional loan, then it would probably make sense to do that.
Yeah. So the like we talked about, you get the deductible right away. That's the biggest benefit I see. Yeah. The other thing is you're paying your money back over a year if you can manage it from a cash flow perspective and you're getting a really good rate.
Yeah.
There's honestly that's a really great opportunity to get. And also it allows you to build for your future and maybe use some of that tax refund money to pay back that loan right away and then pay it back on an installment basis. Yeah. And it allows you to get your investing started right away, as opposed, like a lot of people can't contribute your RRSP lump sum wise, but the RRSP loan kind of allows you to do that. So you get your money in January, let's say, as opposed to getting little tranches the whole year. Yeah. So you're staying invested probably for at least 10 months more each year. And I think it can be a good strategy regardless of, even if you have the cash on hand, maybe taking out the loan because of the, like Tangerine right now, we'll talk about a promotion that both of us got.
Yeah.
Tangerine, which is a bank in Canada, is offering an RSP loan at 2.75%.
Cat's trying to knock over the camera. Classic.
So a 2.75% loan is, I would say, very competitive. The only thing is, like Julian said, you have to invest it in Tangerine. So there is ways to maximize it within Tangerine. And obviously, if you're going to an external institution, the rate boosts up to 8.75.
Yeah. So like the thing that the loan will force you to do is, well, it's if you weren't able to save money throughout the year to then contribute to your RSP loan at the end of the year, this loan kind of gives you like forgiveness in a way and says, okay, here you can kind of do it right this year. We'll lend you the money, and then we'll have you pay it back over the year. And the second thing is it kind of forces you to pay the loan back. So It forces you to save. And since you can't really pull money out of your RSP very easily, then it's kind of a great way to force yourself to take money, borrow it from the lender, and then pay it back over the year. And it's not a long-term loan as well, so it's pretty good.
Yeah, and it's not a big loan as well from a financial standpoint. Depending on how much you're taking out, they will cap your limit. So both of us, for example, are capped at 15.
Yeah.
But then again, our max that we can put in is not 15,000 on a year basis. I think.
What is your
if we
max
use a
now?
50,000 income?
Yeah,
at 18%, which is let's say 20, it's going to be under 10,000.
Yeah.
It's going to be about 10,000. So we can't even use the whole amount of the loan.
Yeah. But that depends on if you have room. Have unused room from the previous
If you have
years.
unused room, you could carry it. You could bring it forward. But I think based on that promotional rate of 2.75, you could get a 1-year GIC at 3% from the same institution.
Okay.
In the RRSP. So you've already made 0.25%.
Yeah.
So you've already made it, and that's a guaranteed return.
Yeah.
You've already made a guaranteed return, and you already got the money up front.
Yeah.
So you're ahead in two fronts. You got the guaranteed return, and you'll get your tax credit in that year.
So then, if you're guaranteed a return for 1 year at 3%, and the loan is costing you 2.75, it's kind of like a win.
It's a win-win-win.
Well, it's a win for Tangerine, but not really. It's not a win for Tangerine because they're lending you money and they're giving you more money back.
Yes, but now you're locked into their institution for X number for until you retire. Yeah, that's the thing. But I think from if we keep that aside, like every time we look at an investment, the bank will always win. It's like in the casino, the house always wins, regardless of how much you put on the table, win, bet. La, 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 la. Yeah. House always wins. Bank always wins. They always take their money. But I think in this scenario, you would be ahead in the long run. I wouldn't suggest that you overstretch yourself. Saying like if you take out a $15,000 loan,
because you have to pay it back in a year. So it's like 15,000 divided by 12, say. So you need to at least be able to pay back $1,000 a month.
Exactly, which is very hard.
Yeah, which is a lot
of
money.
On a $50,000 income,
plus the interest.
It's very hard.
Plus the interest.
Yes. I would say that's extremely hard. If we use 50,000, I wouldn't suggest taking out a $15,000 loan unless you look at your budget and say, hey, this is something I can manage. I have room for this, or you shift all of your savings over to that. If that's something you want to do, then go ahead and take it, and you can use that unused room carry forward, and then you're dropping from 50 to 35 gross income on your tax rate as well. So you will be getting a bigger refund. But if you are doing this, I would suggest 100% when you get that refund, because it's going to be big, do not use it elsewhere. Put it towards your loan.
Yeah, right away.
Use it, or even if you can't, earmark that as loan payments, because this loan is going to be due fast. You have a 9 to 12 month term. Yeah. That's it, and that goes quick, and that's big.
So there's a few things also that they offer. The first thing is that they allow you to defer your first payment for up to 6 months, meaning that I actually read the thing. I have it open here too. Meaning that you can. I read it there. Because it's like 2 paragraphs. If you take the loan out in February, you would only have to start paying it back in July, right? Because that's 6 months. But you have to pay all the accrued interest. So obviously the bank kind of gets you there too. Meaning normally if you'd be paying the loan back the month that you take it out, you'd be paying interest and principal on the loan, right? So the amount of interest you'd be paying would be less. But if you defer payment for 6 months, you'll be paying interest on the $15,000 for 6 months. And then when you start paying down the loan, you'll probably be paying, I don't know, a $16,000 loan instead of a $15,000 loan. So that's definitely one thing that is available, but to use with caution as well, because then you'll have to pay the loan down in 6 months, and that's a lot of money. $15,000 in 6 months, even for you, it's a lot of money.
No, it is.
So it's going to be definitely a challenge.
It's very hard. It's very hard. That's, I think, at 15,000. That would, if you're making 50,000, half of your net pay monthly you'd need probably.
Yeah.
Half of your net pay monthly, which is a stretch.
Yeah. So, long story short, the RSP loan, I think, sort of gives you the flexibility of putting in all your contribution for the previous year without having saved that year. But the interest on the loan is also important. Looking at, in our case, it's a 2.75% APR. So it's not necessarily very high. So it's practically negligible on a $15,000 balance. It's not so high. If we're talking about, $200,000 like a mortgage, then that's different. But on a $15,000 balance, it's not the end of the world, especially if you pay back in a year. The amount of interest you're going to pay on that is, $600. But then if you can make $600, example, guaranteed, like you said, the 3%, right? Then it would definitely make sense to take the loan out.
Yeah. And they have their mutual funds as well, which you can look in there. But those aren't guaranteed. But you could get more on that.
Yeah.
You could get maybe, let's say, if you could get 6 or 7 on that. He's trying to knock over the glass. But it's an interesting thing to use, and I think I'd like to touch on like the whole to never go into debt type of thing, which is this kind of like borders onto it.
Yeah.
Obviously, it is debt because.
But it really depends what you do with the debt.
Yes,
right?
Of course. But I have a feeling that some people, the thing is, it all comes down to what happens with that tax refund.
Yeah.
Because that tax refund, let's say, is going to be, I think it would be, let's say it would be $3,500.
Yeah.
It's what are you going to do with that? And it's always, it's easy to say up front, oh, no, I'm going to use it to pay down the loan.
Yeah.
I have to pay back $1,000 a month. I'm going to keep that. That's going to be my 3 months thing. Usually what happens is when you come into cash that you weren't really foreseeing for that year, it's like, oh, I got $3,500. What can I do with it besides saving?
What can I spend it on?
Yeah.
Pretty much.
So you need to come to the agreement that, okay, this is something I want to do. I'm saving $15,000 for my future. That's amazing. I'm getting the tax refund, but I need to put that tax refund towards paying back the loan. And I wouldn't necessarily consider this the type of debt that is really bad. That type of debt is consumer debt, like credit card debt. If you're taking loans out from like retailers,
or a line of credit just to buy stuff.
Just huge lines of credit to buy stuff, or like constantly missing payments. That's when we're getting into a really bad system. But if you take the 2.75, you say, I'm really risk averse. I don't want to play around with this money. Let me just put it in the 1 year GIC at 3%. You're really getting nothing. You're not losing anything.
But ideally, the way you invest in RSP, especially if you're in your 20s, would be long term, so high risk.
But you can't do that at Tangerine.
Well, you can buy one of their mutual funds.
Yes, you could.
So,
but
you take an all equity mutual fund, and that'll be equivalent to like an all stock portfolio. And that's what I would recommend doing in an RSP. So if you have 30, 40 years, right, to invest.
Yeah, good compounding, good growth, and the distributions.
But I think that the RSP loan plays a lot on human nature, because if you're forced to do something, then you'll do it. Like if you have a contractual obligation to do something, you're much more likely to do it.
Of course.
But then like, okay, I'll save $500 a month for 12 months, $6,000. But it's like going to the gym. Oh, I'm tired today. I'm not going to go, or whatever. So it's very easy to convince yourself not to save for a month or 2 months or 6 months. But for the loan, it's going to force you to do it. So if you have a hard time saving, the RSP loan may be an interesting idea as well. You just need to make sure that you don't over borrow, because then you won't be able to make the payments. Anything else you'd like to say?
No, it's really,
okay, well,
really
that
concrete.
was our sorry.
It's really concrete.
Yeah, I mean, it's not a super complicated topic, but I've never heard about an RSP loan until I saw that. So let's see. I'm going to read the thing and see if there's anything else that's super interesting. Nope, not really. Okay, guys. Well, thanks for tuning in. I hope we were able to maybe teach you something new about an RSP loan. I didn't know they existed. Maybe you guys can try them out and tell us
how it happened.
If you actually made the payments on time, and if how big your tax credit was, or what you decided to invest it in. And we will see you in the next one. As usual, you can reach us on...
you can reach us on Instagram at Personal Finance Boss. Yes.
Okay.
At personalfinanceboss at gmail.com. You can comment on SoundCloud, or you can reach out on our Facebook page.
There you go. See you in the next one, guys.